Getting it to go live, so we preparing the lives, Carly, and preparing the lives.
Okay. Oh,
Are
it's
you-
showing up as me instead of Stacy. Okay.
Yeah. Getting it to go live, so we
Okay.
preparing the lives, Carly, and preparing the
Okay.
lives.
Okay.
Oh,
Oh,
are
it's
you-
showing up as me instead of Stacy. Okay.
yeah. Getting it to go. Okay. On my computer, it was it was talking back to
I
me.
know. I heard that too, and I was like, "Wait, is this gonna happen? If this is gonna happen, I'll just log her out."
Mm-hmm. Well, we're on live right now.
You don't
Okay.
mind. You
Mm-hmm.
know what you're talking about? Log out. Ah,
Mm-mm. Okay. So I'll give the people a couple minutes, Carly. Let's give them a couple minutes because it's
Okay.
7 o'clock on the dot.
Okay.
And we're on time, but sometimes it take people a couple minutes and then we'll just dive right on in like we do week after week and do what we do.
Wow.
Yeah. So how your day been today?
Oh, it's good. Good. We're down in Cape Canaveral. I think they're about to. I think there's a rocket about to go off here, and
Oh,
not long from now, I believe.
wow.
Yeah, a couple earlier in the week too. I don't think they happen that often. There's been like three this week, which is kind of
Really? Do you got family out there or something?
no. My parents have a timeshare, so my parents and my brother and his wife and son all came here. Like they have a son that's right in between both my daughters, so we have like a 2
Oh,
and 4-year-old here.
okay. That's awesome. They get to play together.
Yeah, they do. They like each other too. It's nice.
Of course, that's always nice if they like
Yeah,
each other.
yeah.
Kids can be so mean sometimes.
I know. Yeah, I know. They can be, but and they're kids. They're gonna fight sometimes, but for
Yeah,
the most part,
yeah, it'd be like that.
yeah.
Well, we have given a couple minutes. Let's go ahead and dive right on in. Carly, thank you again for tuning in every week with us, with me. I mean, we're a little team. We're our own little
Yeah.
team, girl. But everyone, thank you all for tuning in. Facebook, YouTube. The post that I made earlier today on the different socials is will be on YouTube with the slides and everything. So if you're on Facebook and you want to see the presentation that we're giving, go on over to the YouTube page. It's Keneshia Haye, living in Jacksonville, okay? And so I'm Keneshia Haye, and we also have Carly McLeod here with Fairway. And today, guys, y'all are going to have a treat, right? So what we've decided to do was to break this thing down for you. We understand that you're purchasing a home and you want to go through the steps and the processes. But what about breaking down that financial part of it? Let's see, what does it really take to purchase a home? And then when you find that home, right, what does the breakdown of the closing costs look like, the down payment, and then what the ultimate monthly payment is going to be like, as well as Carly is going to give y'all a treat and open up her laptop to you guys and show you
Mhm.
how they come to the numbers. And as we're going through the process, if anyone have any questions, leave us a question in the comment and we'll make sure we get back to it at the end and answer those questions for you, okay? So Carly, go right on in. Oh, let me go ahead over my scenario that I said I wanted to kick to you, Carly, right?
Okay.
So I wanted to do this scenario that I'm a broker and I have some houses listed on the market, all right? So I took my buyer out. A buyer came to me and said, "Hey, Keneshia, I'm looking to purchase a house," right? And so I said, "Okay, let me bring you over to my trusted lender partner, Carly, so we could go ahead and get this pre-approval completed for you," right? Carly gets with the buyer. Let's give our buyer a name. What we want to call our buyer?
I've called them Norm and Norma sample.
Okay, Norm and Norma. All right, so Norm and Norma, they got with Carly, they got their pre-approval. I said, "Okay, good job, guys." I sent them out some homes to look at. They sent me back a couple homes. We went out, we saw these homes, and now we are writing the offer on it. And before we write the offer on it, we just wanted to break down the numbers for them to make you feel even more comfortable about what you're purchasing, right? Because nothing is worse than having buyer's remorse after you've purchased and you're like, "Oh my gosh, I overspent.
Mhm.
Um, I don't know how I'm going to eat for the rest of my life because all my money is going into my mortgage."
Right.
So we're going to run these numbers and these scenarios for you. So Carly, yes,
Mhm.
Mr. Norm and Miss Norm, I've taken them out. this house that they're interested in. It's on Royal Dornoch, and the sales price for this house is $369. So if you wanted to, Carly, that link that I had sent you, if you want to show it to them, or if you wanted to show it to
Yeah,
them,
so let's bring it up. So here's the home.
yes,
Let's
yes.
go up to the top here.
Mhm.
Not.
So, and it's a 4-bedroom, 3-bath home, 2,200 square feet. It's a 2-story, guys. The upstairs has some great wood floors. But anyways, you love it. You love it.
Yes.
And so I brought it to Carly, and Carly is going to run her numbers for you.
Yeah. So what I'm looking at here, this is the Zillow link. So, you know, you can access this anywhere. So this tells us our purchase price. This will tell us our HOA. If there is one, it's going to be listed here. Tells us whether we're looking at a single family home or maybe a manufactured home, if that's the case. And some of them these days are really tricky. I have to look at this to know what it is and isn't.
Exactly.
And then you scroll down, obviously the seller, if you need some contact information, here is that. We love that. What I look at too is I'm going to scroll down here, and a beautiful thing that Zillow does for you is tax information. This is a big thing that we look at. So if you go and click on the county website, this will take you to this particular one's in Duval, and we will look at your most up-to-date taxes. So scroll down here, parcel tax record, and this is going to take you and tell you exactly what the taxes are in this house. And almost every county has something like this. So
they do.
So we see the bill for this past year, and we'll be getting new ones any day now. Like they're due November 1st, about 2 weeks from now.
Right.
We see annually, this is what they're paying for taxes. So let me show you how this comes in, because it's a big factor. So here's what I look at on my end, right? I'm going to look at your total tax bill. So let's put all those little things into play that we were just talking about. So I had this in a conventional loan, a 30-year conventional loan, $369,000. Now, depending on what you're putting down, if you're a first-time home buyer in a conventional loan, you can put down as low as 3%, which is nice.
That is nice. That's nice. And Carly, you guys offer that 3% for conventional. Okay.
Absolutely. Yep. So 3% there. So you see that amount here. It'll populate there, $11,000. I've got a 6% interest rate. Doable. You're going to have really good credit and some good down payment to be able to do that. But that's where that comes in. So this is your total number. And let me tell you how I get to that total number on this property. So this automatically populates. So if we know we've got a loan amount of this after your down payment is taken out, we've got an interest rate at 6 for 360 months, which is 30 years. This auto populates.
Okay.
Now, the next piece of the puzzle that we have to take in is insurance. Homeowners insurance, hazard insurance, you hear it called different things. This is the insurance on your home. Now this is going to vary from person to person. I'm sorry, not from house to house.
House to house.
Older homes, especially, you know, there are parts of Jacksonville that specifically have a lot of older homes in it.
Sure,
you
do
can
a lot.
see this number, and Florida insurance, we know, is just a crazy thing. So this number could be higher depending on how old your home is.
Yeah.
That was pricing. So Keneshia, she always has a good sense of what's an accurate number here, and a lot of times we can get with the seller to figure out what they're currently
paying. That would probably be the best bet, is to ask them, what are you currently paying for your home insurance, just to get an estimate.
Yeah. So that's where this comes from. So this is something that you're able to negotiate as a buyer, because you can go shopping and decide. You know, you don't have an ultimate say in what the final price is, but you can shop and find the lowest. And just like car insurance, you can move down your coverages and premiums and stuff like that until you get to something that you're comfortable with. So taxes. Now, you remember we were in this bill and we were looking at a $3,054 tax bill.
Right.
If you let's say $3,054 divided by, we're going to divide that by 12 months, because this is a monthly payment that we're looking at. So 12 months in a year, that brings you to $254.50. That's where that number comes from. So that's your property tax. Okay.
And we won't even throw too many wrenches in there. It could be a little less, guys, if you go ahead and file your homestead exemption. That may be a little less for you, but we're just going to give you some just solid scenarios now.
Absolutely. And this is a piece that probably a lot of people don't realize moving forward. This is something called mortgage insurance. So
Right.
the idea of mortgage insurance comes from the fact that, and people still have this notion in their mind that you have to put 20% down on a home. Obviously, as you can see, you don't have to put 20% down on a home. But because you don't put 20% down on a home on a conventional loan, they charge you something called mortgage insurance. The beautiful thing about this piece on a conventional loan is after you've paid off 20% of the house, so in whatever way that 20% of the home is paid off, either you've paid your bills over years and now you only owe 80% of whatever the value of the home is, that's one way. You could stay where you are and just slowly pay it down, but then your home goes up in value. That also does it. So this piece, and that's a nice little chunk that will come off of this home whenever you've got 20% equity in the home.
Right. And that mortgage insurance is monthly, right?
It's monthly. Yeah, this is all a monthly payment that we're looking at here, proposed monthly payment.
And that's not the same as your regular homeowner's insurance. So the mortgage insurance is on top of the homeowner's insurance.
See, there's two different line items here. So you got your homeowner's insurance here, you got your mortgage insurance here. And should you be on a lakefront property, a beachfront property, something that's on water, you may also have flood insurance.
That too.
So, you know, that's supplemental property insurance should that ever come into play. And the last piece is that homeowners due. You remember we saw that on the Zillow ad here.
Yes, HOA.
The very top, right here, $25 a month HOA. So that is how we come to that total payment. And I guess now we'll kind of talk about how do I know that you can qualify for that? Because I think that's a big question people have is based on my income, can I qualify for this house?
Exactly, Carly, exactly.
So let's go over again what we look at in terms of do you qualify for that house or not? So number one that we're going to go into when I get your application.
Yeah, this is like an application.
So let's say that I'm just reviewing this application for the first time. I'm going to look at your credit. So your credit pulls up 3 scores for you, 3 scores for your co-borrower if you have one. Now, the credit score for decision making is a 701. Now, how do we get to that one random one out of these 6 scores? Well, let me tell you. So you each have 3 scores, and I have them just listed here in order because this is a sample. The middle score on this one is a 701. You see, it's not an average. It's not the average of these 3 scores. It's just the one that's in the middle of the 3.
Got
the
it.
score of this one is also an 18. See? And we take the lower of the 2 middle scores. So that's how we get to 701. Because a lot of people will say, oh, my wife or my cousin or whoever is signing with them, they have a credit score. Should we get them to help? And I tell them, it won't help, unfortunately, because we can't.
I don't think I even knew that either. I thought that would help. Oh, wow.
No, it helps to bring a co-borrower on if they have more income and minimal debt. The fact that they have a better credit score is not going to help you. So if you have somebody coming in that only has debt and has no job, we're not going to add them. They can be on title if you want them to be on title, but you know, what we want them for typically is their income, and I'll show you how that affects things too. So, you know, we're going to go with that middle of the 2 scores and the lower of the 2. Okay. I'm also looking at what comes in from your credit report.
Okay.
So this is a huge piece too, and I'll tell you how this plays in. So for example, things that come in all the time, student loans, especially with younger borrowers, help with older borrowers too, because they're paying these for their life, I swear.
Telling you.
So that all comes in one big long list for us. So we'll see, you know, when somebody has a student loan, they don't have 1, they have 15. It's a bunch of small 2,000, 3,000, 6,000. Sometimes you'll have one big chunk one, but it's usually a bunch of small ones. And we see all of your monthly payments that come in here. So that's really what we're concerned about. So for example, student loan, maybe you're paying $75 a month, maybe a car payment, $400 a month. Maybe you got a credit card that's got $5,000 on it, you got $50 a month. So we're looking at $525 worth of debt.
Right.
Okay. And what the 2 biggest numbers, they look small on the screen, but these are, can I highlight them? It won't even let me. These guys right here. This is the stuff that tells me how much you're going to qualify for, and I'll tell you why. So this number is called your debt to income ratio, DTI. You hear that all the time. So what is this number? This number is a combination of, we're taking the total debt that we have here and anything else that we find out, like say you have, say you pay alimony or child support, something like that, and that comes in, it's maybe not listed on your credit report, but it comes in otherwise, so we count that. So we take We take your total monthly payments there.
Okay.
And you guys remember what the loan payment was here? It was about $2,800.
Mm-hmm.
$2,800 here. We add those together. So that ends up being about 32, 33, something like that.
Okay.
And then we look at your total monthly income.
Mm-hmm.
Total monthly income. So let's
Okay.
see, where is my income button? Your total monthly income. I've just made it up. So total monthly income of $8,000. So
Okay.
you can see that if you have, say, what was it, like $2,300 divided by 8,000, you know, that's something that we're looking at now. That's calculating a little high for some reason. I'm wondering what's going on. Oh, I typed in the number wrong, didn't I?
What?
I typed in, it was like $2,800 plus another $500, right? So we got 33. So that divided by 8,000.
Okay.
So you see 41, you just gotta
Yeah.
put a decimal back. That's about what that number is, right? That's how we get to that number. This
Okay.
number is just the total housing payment. So what was that mortgage? It was about $2,800
2,800. Mm-hmm.
divided by 8,000.
Okay.
That's where this front end comes from. So we have
Okay.
limits on both of these numbers that you can't go over. So why am I explaining this? Because this seems tedious, right?
Mm-hmm.
It's a huge number because on a conventional loan, this has to be below 50. So you see,
That's the main point, is to
that's
stay
the
under 50.
main point is that number has to
Okay.
be below 50 for a conventional loan. So we've gotten Miss Norma and Mr. Norm together. They're good, right?
Right.
Let's say Miss Norma was not on this application.
Yee, where does that put us?
Now we're at 66.
Ooh.
Now you no longer qualify.
Knocked
Oh,
out.
what could you do? What if you had the money and now we're going to pay off all this debt? Let's see how much that helps us. So
Okay.
let's pretend like we're paying this off.
Okay. And see if that changes the debt to income ratio.
Oh, I unclicked it. So now you're still over for conventional, right?
Mm-hmm. Mm-hmm.
But here's a fun side note. If you go with an FHA loan,
Oh.
you can go up to 57 on this number. So guess what? You're right under on this number. You're right under 57. Now maybe we go, okay, now you got to be in an FHA loan because that allows you to go up a little bit higher.
Mm-hmm.
So now you're not a conventional buyer anymore. You're an FHA buyer. Let's see what we change there.
Let's see.
Mm-hmm.
And so, guys, that is one of the great parts that I wanted to definitely show you, that it's different types of loans and then different types of requirements too. So go ahead, Carly.
So this is where that comes in. Now that we've got an FHA loan, they have a little bit higher down payment. So now your down payment goes from 3% to 3.5%. So you can see that jumped up, what was it, about $1,800 or so? But that actually brought your payment down a smidge because you're paying a little bit more down up front. But you're, that could change your interest rate because this is a different program. But let's look down. So let's see, okay, now we qualify with our back end here under 57. Great, we solved the problem, just switch loan products. Let's see then, I'm gonna show you what your down payment looks like now. So your total down payment here is, oh, what is it saying?
I know, girl.
Something went wrong.
That borrower would be like, Keneshia, what is going on?
Yeah. Hold on, did I not click through or something? I don't know why it's saying it's $100,000. What in the world?
It's all right.
Yeah, that's not accurate.
Yeah, that's not accurate. I don't know why.
That's not accurate at all. I don't know why that jumped up, but we'll go back and we'll put a regular one down. Maybe it was just messing. But so just to show you kind of what things look like, and we'll put Miss Norma's money back up here. I don't know
why money would have messed that up down there too.
I don't think so. This is why I don't know why. It's probably one of these things where I got to save it and then it'll come back to me.
Okay.
Oh, that's why. Sorry, because we're paying off all these debts.
Okay. Okay.
So let's go back out here.
This is real life, y'all.
That's real life. So if you were having to pay off all those debts to get under 57, like we were in an FHA loan, then now you got to come to the table with another $80,000 or whatever this is. That's where that came from.
Yeah.
So now we're looking at our cash to close again. This is the money that you actually bring to the closing table.
And that's more like it.
Yeah, that's I forgot that we So we're paying off that stuff. So now you're looking at bringing around $22,000. And honestly, that's probably a high estimate. They're always high to begin with because we don't know what all these
Exactly.
will be, and we overestimate. But where does that come from? That comes from your prepaid items, which are your escrows, your taxes, and your insurance. The rest of your closing costs, which are our lender fees, your title work, things like that, your survey, all that good stuff, and then your down payment. So that's where these two numbers. So you see, this is about 11 here, this is about 11 here, and that's how you get to 22.
Got you.
So that's what you're. Now, do we want to look a little bit more in depth about what actually goes into these closing costs so you can understand?
Definitely. Because you get that a lot. A lot of buyers always ask, so what really goes into the closing costs?
Yeah, well, let's look. Let's show you here. So things like real estate admin fee, that's common. Sometimes that's charged and sometimes it's not. We add, another reason why things look high at first is we have to add everything in there that could be in there. And then by the time we close, we can start ticking off and taking away.
Right.
Either you've already paid for in the process or that just doesn't exist. We have to see why, like they always say, cover your butt.
Yes.
You got to cover your butt. We have to put it on there because it could be charged so that you know that it's possible. And if it's not, then we take it off. So these are our lender fees. So we charge a processing and an underwriting fee and a verification fee. Those are pretty standard. We charge an appraisal fee and an appraisal admin fee. That's that 120 and that 500. Credit report. This is a charge for your credit report whenever you pull your credit. And then a flood certification. We talked about, you might have flood insurance. We pull a report to see what flood zone that you're in. So then there's a small charge for that. And if you are in a flood zone, we require you to have flood insurance. Okay. So, and then now we're looking at all of our escrows and that kind of thing. So a fun fact that you may not know is your closing costs will vary depending on what day in the month that you close, actually. So if you close on the very last day of the month, you'll only have 1 day of interest that they'll charge you. If you close on the first day of the month, you'll have 30 days of interest that they'll charge you. So I don't know if it'll let me play with this since I have a date in there, but no, it won't. But so you see, this is saying that we're going to close November 29th. So you just got the 29th and the 30th, 2 days of interest that you're charging. But, multiply that by 15. If you were closing on the 1st, then, it's not, compared to $22,000 that we're paying, is not the craziest charge in here, but it's something to be mindful of, that you do save money depending on when you close.
When you close. That's good to know. That is really good to know.
And 12 months.
Late closing date.
Yeah. 12 months of homeowners insurance. We charge that. We charge another month, a couple months as well, again, of your homeowners insurance and property taxes. That's just standard. Those again are all your escrow type fees. These are your title insurance fees. So
real quick, Carly, back up to where the insurance and the property taxes are. So you guys do 3 months, or it varies? Does it vary on the loan? How much you guys collect?
No, it's usually a year plus 3 months.
A year plus 3 months. Okay. And this goes where? To the escrow?
This is escrow. This is prepaids and escrows.
Okay.
Yeah. Reserve deposited with lender. Reserves deposited with lender. That's what all these charges are here.
Okay. Got you.
See, we're not doing your mortgage insurance and we're not doing your HOA. We just do your homeowner's insurance and your taxes.
Okay. And those numbers are factored into the loan amount, not the loan amount. That's the closing cost. Okay.
The closing costs. Yeah. So let's say that your homeowner's insurance came in at $100 a month. It was only a $1,200 annual policy. That's that much less money that we have to collect from you at closing. So that's another factor that helps it. If your property taxes are particularly low, something that I do warn people a lot about is your property taxes. As you saw, we looked them up. They're based on the current property taxes that the owner has. So let's say that home hasn't been sold in 20 years or something like that. Your taxes could be very, very low, because if they did have it homesteaded and it just, they've kept that appreciation down, they could be crazy low. But your home is going to get reassessed because you saw there's going to be appraisal. And then your taxes are going to be reassessed based on that new value. So it's possible the taxes could have a large jump. It's possible it could jump almost none. Possibly it could go backwards if the previous person didn't have it homesteaded. Like
that's true. That's true.
Your taxes could be less than what we're doing now. So it just
and typically Where we see those tax differences, Carly, is on the new construction homes, because
Yeah.
typically the taxes are being taxed on the land
Oh, yeah.
and not on the dwelling. So it's when you move in and then the following year, tax year, your taxes will go up because now you're going to be taxed on the dwelling as well as the land. Okay.
Mhm. Yeah. So people get stunned by that. I try to really make sure people know that going in, because they hear fixed rate mortgage and they think fixed rate. That means this is my payment forever. What's fixed are the tax or the principal and interest. That,
Right.
whatever your loan amount is and your interest rate, that's what that's based off of. What your taxes and your insurance and your HOA do from here on out, we have no control over, and they could change. They could go up. There's only limited cases when they go down, so I would just be mentally prepared that the value of your home is going to go up, your taxes are going to go up.
Mhm.
It's just something to think about going in. And so then the next part of your closing costs, this is title work. So a lot of people you may not know what title work is. So a quick explanation. Title work is a funny thing of insurance that basically dates from when you bought the house previous. The idea, it's the opposite type of insurance. Normally insurance is for you going forward. This is going back. What this is saying is that lawyers have looked into the chain of title of your home and ensured that there are no liens or anything against the home that you're buying that could come back and bite you in the future. So if anything were to be discovered post-closing and you found out that somebody has some tax lien or something on this house that was not disclosed to you, you are not responsible for that because you have title insurance on your home.
Exactly.
So that's what this is doing. It's just making sure that you're buying a home free of anybody else's BS that could have been on before.
Uncle Sally or Uncle Sam.
Yeah.
Don't get it.
Yeah. So that's why that exists, to make sure that you own the home, free and clear of anybody else's previous liens.
Exactly.
And that's what all this was. So you have, a lot of things that I honestly don't even fully know what they mean. They're just common parts, things that title do. A title search, lender's insurance, recording fees, putting your note and everything into recording.
Yep.
Transfer
Recording at the county tax office. Yeah.
Transfer taxes, all this kind of stuff. And then this last one is just anything extra. So a survey fee. If you're buying a manufactured home, you have to have an engineering certification. That'll be down here. If you're buying a home with a VA loan, you have a pest inspection. That's going to be down here. And one thing I didn't show you, if you guys decided to buy down your interest rate.
Oh yeah, that's a
I
good
can show you this. So let's say you want to buy 1 point. So the point is based on your loan amount. So if you buy 1 point, $3,500 to buy it down 1 point, because it's based on your loan amount again. So it's basically 0.01% of your loan amount to buy it down. So that's something that you keep in mind. Now, this can be a confusing number because 1 point does not equal 1 interest rate point. I feel like
I didn't even want to ask.
I feel like I'm getting in the weeds. And
don't go in the weeds, Carly, because that's why I did not ask, because that is just a rabbit trail to go down.
I mean, I can show you what this looks like. We can pull up,
Sure.
I'll take you really behind the curtains and I'll show you even what what credit scores and stuff like that look like. I think I needed to switch something here though.
Sure.
I think I need to switch it back to 5% down because it was playing with something. But let me change this really quick, and then we'll go take you really behind the scenes here and show you what this pricing looks like.
Behind the scenes.
And how full transparency here at Fairway. We'll show you everything. And I'll show you that. Look, we're putting 5% down. It only did it down a smidge, but you see your DTI went down a little bit because your loan amount's slightly smaller. So let me show you what this looks like.
Wow, this is awesome.
Yeah, behind the scenes. This is
behind the scenes.
Look at every day, and I'll show you where your interest rate comes from. All kinds of the questions that we get asked.
Exactly.
So we can tell you what goes into giving you the interest rate that we're giving you.
Yeah.
I need a little slow here.
It's okay. It's at nighttime. A lot of people home.
I know.
So the internet moves.
We're going to submit this. So this is basically just pulling in all that information that we have in the loan file.
Okay.
And we were in a Fannie Mae. So let me show you what this looks like. So when we're looking at pricing, we typically have to go to 100. So this is the price. So anything under right around 100. So the interest rate on this loan would be a 7.375.
Okay.
Okay. And what you can do is you can always buy down your pricing, almost always, unless you're in like a down payment assistance program, you can't, but just if you're not
Okay.
using down payment assistance. So when we say 1 point, we're saying we're going from 100 to the equivalent of one of these points down. Okay. So we're going from basically like 100 to here. So 1 point will get you to 699 from a 7.375. That's kind of how that works.
Okay.
So that's, and I'll show you that too. So you can essentially buy, or let's do the opposite. You don't have enough money for closing. You're willing to pay a higher monthly payment. We can give you money back to go higher.
Oh, wow.
You don't usually go that route because obviously everyone.
Yeah, nobody wants to go higher.
Yeah, and I'll show you something
But
too.
it
So
is-
let's say you did have a better credit score. I want to show you the impact. So you saw you would have had a 7.375.
Okay.
Let's pretend like you just have like superior credit here.
Okay.
Almost
Matters.
because it matters, because your credit score matters, and I'll show you how much it can affect you positively. So let's open the same pricing engine back up.
Okay.
And now, where's that 100 at? It's right about here. I could get you to a 6.875. So just a matter of your credit score being 100 points better. You save, what's the difference between 24, 21, 20? You save 120 bucks basically a month. You see that?
Okay.
Because this is what your principal and interest would be at the 6.875. This is what your principal and interest would be at 7.375, and that's about what, like $118 difference.
Right. Right.
So it matters.
Especially over time.
Especially over time. So this is basically what we look at for pricing. And if you're closing quick, we can say we're doing only a 15-day lock instead of a 30, and the pricing is even better.
Oh.
So that goes down too. So again, see the other one, 100 was right at, sorry, this one was a 6.875. So they're about the same. It's not a huge difference, but again, like a 6.875 or so. So that is how pricing works. So, what other common questions that you get, Keneshia?
Well, the difference in these loans, I see that we did the conventional FHA, the VA. Now, I know the VA doesn't have a down payment, right? As well as the only other bad thing about the VA, if you must say, is the funding fee. That will be added into the sales price.
Yeah, so I'll show you something too that we have to add. Let's talk about VA funding fee, FHA, upfront mortgage insurance. We already talked about regular mortgage insurance that you pay in terms of a monthly payment, but let's look at what FHA is going to do. So let's just change this program here, and it'll start populating the extra things that go on with an FHA loan. So let's say we go FHA. So you're going to have 3.5% down automatically. You see how it removed that mortgage insurance?
Right, because it's a VA loan.
This one, we're going to do FHA first. So
we're going to do FHA, okay.
It also has a mortgage insurance piece.
It does.
Monthly mortgage insurance here. So that's going to populate in there. So the same loan on a conventional, if you go FHA, you see that mortgage insurance piece is a little bit smaller. It's one, unless you put a pretty good amount down on a conventional loan, the mortgage insurance is usually lower on an FHA, but it also adds this piece that wasn't there before. You see that? That is called upfront mortgage insurance, which is not something that goes necessarily directly into your monthly payment. But you see how previously on the conventional, this was your loan amount.
Right.
Now add this to it. Now this is your loan amount.
Oh, wow.
So you are paying it, but $6,000 is spread out over 30 years as opposed to paying it at the closing table.
Okay.
So let's do that. So now let's switch it to a VA and show you how that changes everything. So now with VA, We'll switch that out. And obviously this could change your interest rate. Every program has somewhat different interest rates.
Different ones. And
I
that's
love
good
it.
to know, good to point out. And what I love about what Carly does, guys, she checks the same way she's checking right now. She checks to make sure which loan is best for you.
Mhm.
I'm so appreciative of that, what she does for my clients. So
Mhm.
yeah.
So just for example, we're taking that down payment out. That's gone now.
Mhm.
And you see, a VA loan does not have any sort of mortgage insurance. So
Right.
that little piece is gone. Now, what we have to change is our funding fee, unfortunately, and that's gonna vary from veteran to veteran. But
Exactly.
let's say you have something like a 2.2% funding fee, and you're gonna see that populate up here. So see, your funding fee varies based on, is this your first use of it? Are you already using part of your entitlement elsewhere? Because entitlement is a big piece of a VA loan.
Mhm.
And this is another piece that, just like that upfront mortgage insurance, is added to your loan amount.
Right, right.
See? So basically, I mean, you're seeing what a VA loan will do for you. You have no down payment. You do add that funding fee, and let's just assume they all have the same interest rate.
Yeah.
This is a cheaper payment.
Mhm.
And even though, it's going to be a higher loan amount because you're not paying any down payment, but because you're losing this mortgage insurance piece by being in VA, that just makes your monthly
Yay.
lower. So this is why we love our veterans.
Yeah,
So we give them good
that's
deals.
a great incentive.
So that's how that changes that number. So now you come down to these closing costs. And I
Mhm.
know these numbers might be off because they're not totally played in here, but now
Mhm.
see that number? That's about half of what the other one was, because you no longer have a down payment.
Exactly.
Keneshia can get you that from the seller a lot of times.
A lot of times. A lot of
Not
times.
every time. Not every time.
I get you some, at least
Yes.
some.
So let's say, for example, that you are looking at $369,000.
Mhm.
Keneshia can get you up to 4% seller credit on this home.
Okay.
So that'll be 14 instead of, I don't know what I hit, but it'll be so that she could get you up to $14,000. So let's say she gets you 12.
Mhm.
Now you have no closing costs. Now you're coming to the table with nothing.
Yep. And
Closing table
possibly getting your binder back.
and possibly getting your binder back. Because yeah, this isn't assuming I haven't put any sort of deposit. You almost always make a deposit on the home, which will.
Mhm.
So whenever you pay your deposit, let's say you paid for a survey up front, let's say you paid for your appraisal up front, all of those costs, if you do pay for them, are ticked off of that checklist that we were looking at earlier. So
Mhm.
once they're paid, now your closing costs come down by those amounts. So it's great to see how these fees aren't just fees that go nowhere. They're
And
fees
Carly,
that
quick question for you, Carly. With the different loans, they're allotted a certain amount of closing costs that the seller can contribute, right?
exactly. Yeah. So the highest amount that you can get is with an FHA loan. So they can give you
Okay.
6%.
Okay.
A VA can give you 4%.
Okay.
And a conventional will vary depending on how much money you put down, but typically it's 3%. If you put down more than 3%, it goes up 3, 6, and 9%. I think it can go up to even, but you have to put down a pretty good amount for that to be an option.
Mm,
So,
okay.
so yeah. So that deep dive here into what we're looking at. Do we have any questions? I might have just thrown a lot of information at everybody.
Let me see if I have any question over here. I don't see any there. Nope, I don't see any questions yet.
Okay. Okay. Is there anything else that we want to talk about then?
Well, we just talked about this house here, and that's exactly what I wanted to do, Carly, was to really dive into this and just break it apart and really show people behind the scenes like you just did.
Okay.
And gave the scenario of this house. We took them out, gave them the pre-approval first, took them out, found the house that they were looking for, right? That was a scenario we started with. And they identified this house that they were interested in and brought them back to Carly, like, hey, Carly, this is the house. We made an offer in on, well, he wants to make an offer. Mrs. Norm and Mr. Norm wants to make an offer on it. But first we wanted to show them the scenario of what their payments would be like if they chose this loan versus that loan. So I think we accomplished that.
Okay.
I think we accomplished that.
Yeah, I feel like one thing I'm going to address and then we can stop is a lot of people will say, how much money do I have to make to buy X amount of home? I
Yes.
hope that you've seen that that's a tricky question because typically you can sort of think of it as usually most loans are 50% or under, 50% DPI or under, DTI. So if you have no debt whatsoever, you can basically say, what is half of my monthly income? And that's the total amount of mortgage that you can pay, basically. But that's assuming you have no debt. So I can't tell you, if you have 3 car payments that come in on your credit report, and you're paying $2,000 a month in car payments, well, then now we have extra debt that we're dealing with, and your income is going to have to be higher to make up for that. So I would just say in general, I think a good place to starting from is your income, and you get to use your whole income, whole income. So this is before taxes, before your health insurance that might come out of your paycheck, before any of that stuff. Social Security is taken out of it, all that kind of stuff. We get to use your full monthly payment before all of that. So you don't have to be looking at what you take home and divide it from there. We can use the whole thing.
Never heard that before. That's good to know.
And if you're somebody who's retired, who's on Social Security and stuff like that, sometimes we can even take what you have in your Social Security and we call it grossing up. You get an extra 25% on top of that because it's not taxable income. It's not taxed the same way. So we have to look at your taxes for that to make sure that they're not already doing that. But yeah, so you get to use more of your income than you think you will. So the question becomes more difficult than just how much money do you make before I can afford this. You can kind of see like, okay, how much money do you make? Minus all the stuff you have to pay for every month.
Exactly.
Minus the cost of this new proposed mortgage that you're taking out. And then we look at it. And then this is your friend or your enemy right here, this guy. And then we start kind of picking at it. Like, okay, do we have a small credit card that we could pay off that maybe would get us right under if we're at like 51 or something like that.
Exactly. And you do that too, Carly. I've seen where we were like really close to something. You was like, okay, Mr. Norm, pay this off here. And then you guys do, what's that, a rapid pull?
A rapid rescore. Yeah. So let's say, we can do stuff where we're just paying stuff off at closing. Like say you have a small credit card, but it's charging you $200 a month or something like that. And you owe $500 on it. Then that's a superb example of something. We're going to pay that off at closing. You're going to pay that $500 off at closing. And that's going to give me $200 of income back a month that we don't have now. So that can be huge in changing from a $200,000 house to a $225,000 house maybe, or something like that. That can really change your profile. But yes, we can play with things like that. We can put a little bit more money down, which ends up lowering your monthly payments. We can try to get you the absolute cheapest insurance that you can possibly find. I've pulled that trick a couple times where we just bottomed out every piece of insurance where it probably wasn't even a great policy to have. But what you do is we close with that policy, and the day after you close, you go and change it. You bump it up.
You go shop because it's all about getting qualified at the end of the day.
Yes.
And you can always go shop for that.
Yep.
Yeah.
Yep.
Well,
so I hope this was helpful. I hope this showed you guys some things that maybe you didn't know. Pulled the curtain back a little bit so you can see what we do.
Another question I have for you, Carly, the different loan types that we just talked about, what's the interest rate requirement for those different types of loans?
Like the credit score requirement?
Yes. I'm sorry, I said interest rates.
No, that's okay. I knew what you're saying. So a VA loan, or do you want me to pull up our thing again? We can click through. Oh,
sure.
Not that. Where's my PowerPoint here? We can click through this too. Let's look at, I'll show you maybe some quick things. So, where is it? So this is your down payment requirement. So just so everybody can see this. So 3%, we were talking about a conventional, it's 5% if you're not a first time home buyer. And then FHA, you saw we played with this, it was 3.5%. And then VA and USDA are both 0. As far as your credit scores. So conventional requires you to have a little bit better credit. So you got to be a 620 here. FHA and VA are a 580, and then USDA is a 620 again.
Okay.
And then if you want it, we talked about down payment assistance a little bit. In Florida, we have a bunch of great programs, but the Florida Housing has several good ones.
Mm-hmm.
The Florida Assist is something that has not run out of money and does not seem to run out of money. Hometown Heroes is unfortunately out of money right now, but this will
Right.
give you $10,000 towards your seller credit. So say Keneshia couldn't get you any seller credit because the seller was just not willing. If you're a VA buyer and you get $10,000 worth of down payment assistance, again, you're coming to the closing table with nothing.
Zero.
Zero money. And like she said, sometimes you're even able to get your deposit back. So programs like this just require you to have a 640. So you have to have a little bit better credit. You have to be under certain income limits and things like that to qualify, because they're not giving $10,000 to people that make $500,000 a year. They don't.
Right.
They're giving.
Right.
They want to make sure that these funds are allocated towards people that need it.
Exactly. Exactly.
So yeah.
I think we touched on everything, Carly. You know, an idea that came to my mind, if I don't know if anyone has asked, but I do have one of my agents that work with me. She's interested in purchasing now. She wants to purchase, but she's a 1099er. So
Okay.
I know that's too broad right now to talk on here, but
Yeah.
I think we should come back and give those scenarios on a 1099er.
Yeah.
Mhm.
1099 is I feel like a kind of easier loan to do too.
Really?
Because 1099, the income is super simple. We look at your 1099, we count 90% of that number, and then we divide it by 12 months.
Oh,
It's pretty much that simple.
okay.
So now we're going to look at it over 2 years.
Hmm.
And we're basically going to average it over those 2 years, unless you made less this year than last year. If they're seeing that your income has declined, then they're
Okay.
just going to use, it's kind of a worst case scenario almost. If your income is
Mm.
declined, they're going to use this year and divide it by 12, or
Okay.
they're going to take the 2 years. If you did go up in income, like we all hope to,
Hmm. Hmm.
take the total of the 2 years income, 90% of that, and divide that by 24. So divide that by 2 years, basically. So 1099 income is really,
Here.
it's one of the easier ones. It's like retirement income.
Oh,
Is
wow. And
all my retirement
do you guys also do bank statement loans?
bank statement loans, DSCR loans.
Okay.
These all fall under the category of non-QM in our books. So basically not your standard FHA conventional VA or USDA. They're like different types of income. So a DSCR is one for investment properties. You're
Okay.
basically just qualifying based on the income potential of a home. So
Mhm.
that's not your primary or anything like that. You're just doing that for an investment
Investment.
property.
Hmm.
Bank statement loans can do either 12 or 24 months, where we're looking at your bank statements every single month for those 12 or 24 months and pulling all the income out of that and seeing what that is. That's really good for people who maybe your taxes don't accurately reflect your income.
Mm.
A hole that people get into a lot of times with taxes is you want your taxes to be as low as you can when you file them, because you don't want to pay a bunch of taxes on it. But then when you come to me needing income, I'm looking at your
Mhm.
taxes for the income, and now you're just kind of understated. So
Yeah.
you want to be able to qualify for more because you know you make more. People like that might end up going into a bank statement loan, because that could be
Okay.
we look at your bank payments, we see the income that comes in, and we calculate your income based on that.
And I guess it will be like a difference in interest rate for the different
They
types.
are, yeah,
Okay.
anything that's outside of these QM loans, again, like a
Right.
conventional FHA, VA, USDA, you usually have to pay for it a little bit through the interest rate.
Okay.
So like I'm doing one now that's a 1099, and it's in the low sevens. So it's not crazy.
Yeah.
But compared to if it was just a regular loan, it would probably be in the sixes somewhere instead.
Mm.
So
Okay.
you pay for it, but you can always refinance later into a regular product. If maybe your income right now is just a little weird, maybe you just started your business or something like that, and you
Mhm.
don't have the normal income to qualify, that's another way that you could go.
Oh, that's
Yeah.
good. Well, we'll dive into that.
Yeah, we've got to dive.
Because I'm sure it's a whole slew
A
of things
whole
to
thing.
discuss
Yeah,
on the
absolutely.
investment side and what products you guys offer.
Uh-huh.
So I'll check again to see any comments. Do. Oh, yeah, I see one comment. Hold on. Ah, thank you, Cherie. Good seeing you. I ain't see her in a while. She was my loan officer in Texas.
Oh,
Yeah, she was my loan officer in Texas. Good seeing you, girly. Yeah. Well, Carly, thank you for tuning in and giving this great knowledge that you gave today and opening your book, your computer to us and showing us the
yeah,
back door of how you guys get to the closing costs and all the numbers and the calculations.
yeah.
So thank you for that.
Absolutely. This is an open door here. We're not
Mhm.
trying to hide anything from you. I always say this is one of the industries where we're all on the same team. Where you want to
Yes,
buy a house, Keneshia wants you to buy a house, I want you to buy a house. We all have to be in it
exactly.
together. We're all basically just fighting an underwriter at the end of the day. So
Yes,
you
yes.
can, I'll show you my screen anytime you want to see it. There's nothing to hide. So you guys can feel free to ask all the questions. I've got our contact info up here in case you
Mhm.
guys need something that requires a little bit more one-on-one attention to discuss. Reach out in any of these ways. These are cell phone numbers as well that you can text, emails, obviously. So we welcome any questions that you guys have.
Yep. So if there's no other questions, guys, at any time you can leave us a comment on Facebook, leave us a comment on YouTube. For those of you that are watching on YouTube, thank you guys for tuning in. If you want to see the slides and things like that next time, come on over to the YouTube channel. It's Keneshia Haye, living in Jacksonville. Okay, so you can come on over there to the YouTube. I'll let you guys know when the next one is going to be. We try to do one every week. We're in between Fridays and Thursdays. We try to do lunch as well as dinner time. So we'll see next week if we're going to do a lunchtime or a dinner time one, just to make sure that we're engaging with as many people as possible because we know different work schedules, right? So some people may not be able to take a lunch break. So therefore, we're doing it in the evening times. Go ahead and captivate or capture anyone that's not able to do it during lunchtime. All right, guys. So thank you all for tuning in. Thanks again, Carly, for tuning in with me. And I hope that you guys have a beautiful night. All right. Come back next week. We'll have another topic. We may do the 1099ers.
Okay.
Let's see.
Okay. Thanks, guys.
All right, y'all. Thank y'all.
Bye.
Bye-bye.